In this video, we'll explore some basic information on student loans. As you saw in the starting out article and video, student loan debt is a national issue, and failure to repay the loans can have a tremendous impact on your life. How big is this problem? Recent statistics indicate that in 2019, total student debt in this country is $1.56 trillion. That's spread out over about 44.7 million Americans who've borrowed student loans. That's about $521 billion more than the total credit card debt in the United States. Even more troubling is the fact that nearly 12% of all student loans in this country are currently at least 3 months delinquent or are officially in default status. For those loans not currently being deferred, the average monthly payment is $393, while the median monthly payment is $222. In 2017, 65% of those graduating from public and nonprofit colleges had some student loan debt, and the average was $28,650. So whether you're in college now, have graduated and have loans to manage, or think you might attend in the future, or even if you have a friend, family member, or child who will ultimately need your support or advice, it's a good idea to have an understanding of the student loan process. While specifics may change over time, understanding how to plan, save, and budget for educational expenses will be a lifelong skill. When you hear about financial aid, you'll probably hear a lot of jargon or terminology. And while you don't need to memorize all of it, let's start out with a basic differentiation of the two major types of aid you may be eligible for: need-based aid and merit-based. Need-based aid is focused on the personal and family financial situation of the student. It considers household income and assets, but it also considers things such as the number of students in school at any given time. So a family with a $100,000 annual income and 3 students in college could be eligible for more need-based aid than a family with a $60,000 annual income but only 1 student in college. The other major type of aid is merit-based, which is primarily about grades, achievements, in your field of study. For example, some scholarships might be offered for students from a certain town with a 3.5 GPA who are studying history at the local community college, while another student might be eligible for a scholarship offered by her parents' workplace for all employees' children with a 3.75 or above in high school. Once you've determined that you would like to attend college, trade school, or graduate school, you should begin the process by completing the FAFSA, which is the free application for federal student aid. This annual process does not cost any money, but can play a vital role in helping you to assemble the best possible package of funding for your education. And it's important to note that it's not just used to award need-based aid. You may have heard that there's no need for middle-class families to complete it because your household income may be too high to qualify you for any aid, or that you shouldn't bother if you don't plan to take out loans. But the FAFSA has many benefits. First, it determines a student's eligibility for federal work-study programs. In addition, many states and individual schools use it when determining what aid they may award. A state may have its own grants and loans with different requirements than the federal programs. Colleges also use the FAFSA information, combined with the student's academic record, to award their own scholarships not only for need, but also for merit, including those based on field of study. When do you need to fill out the FAFSA? The answer is every year that you plan to attend school. The FAFSA is not a one-and-done process. Once you complete and submit a form, it is good for all schools you might consider, but it is only good for that year. For example, the 2019-2020 FAFSA is good from July 1st, 2019 to June 30th, 2020, and it was available for students to begin completing it back in October of 2018 when they would have used 2017 tax information if applicable. While the 2019-2020 FAFSA could be completed up through June of 2019, many states have earlier deadlines for inclusion in their state financial aid awards, and schools may award aid on a rolling basis. So the sooner they can consider your application, the more money you may get in your award package from that particular school. Not only does the federal process require a new application every year, it may be to your benefit to complete one as well, as your information and needs may change. If your income or family structure changes, you may be eligible for different funding next year than you were this year. And if you're not quite ready to fill out the form, or you're thinking about school but don't know yet what your funding options may be, you can visit the Department of Education's FAFSA Forecaster, which will give you an idea of the types and amount of aid you might qualify for when you complete and submit the full FAFSA form. Remember that many young adults are required to provide not only their own financial information, but also that of one or more parents or guardians, depending on your age, financial independence, and family situation. You need to provide information from income tax forms and other documents, including bank balances. So it's best not to wait until the last minute in case information you need to complete the form is not readily available. Then what? Once you've completed the form, you'll find out your EFC, or Expected Family Contribution. Your EFC is an index number that colleges use to determine how much financial aid you're eligible to receive, and it's calculated according to a formula established by law and the information you provided on your FAFSA. The formula assumes that you and/or your family will contribute that amount. It may be through savings, work, private scholarships you've obtained, or other sources. Your form is then shared electronically with any schools you wish to provide it to, and they can use it to determine what financial aid they can award or offer to you. This can be in the form of a combination of grants, scholarships, and work study, and your total financial aid package may include suggested loans. You are never required to take out a loan if you have some other means to pay. Their offer may take into account the total cost of attendance, which doesn't necessarily just include tuition and fees. They may also include room and board, as well as some amount of money for commuting to and from campus and for books and supplies. Because their offer may include this, you might see a financial aid package that's for more money than your school costs. Some of that could be loans. Remember, it's up to you whether you accept any loans or whether you choose to accept any type of aid that must be repaid, especially if it's for additional funds that you don't need. When you consider financial aid offers from various schools, it's important to compare the true net cost of your attending that school. For example, while a private school in your state may cost $35,000 a year, their total endowment or available funds may allow them to offer significantly more financial aid than a state school that costs $10,000 a year. So if the private school offers you $27,000 a year in aid and the state school offers $2,000, your net cost for each school would be the same, $8,000 a year. Weighing those offers and considering how much of each financial aid package must be repaid when you graduate can help you truly determine which offer is the best deal for you financially. Choosing a school is hard. Figuring out what you want to study and which schools may offer you the best opportunities to succeed, but it's important that you not limit your choices based on the total cost alone. If a more expensive school can offer you a lower net cost and still meet your academic needs, it's worth considering despite a higher sticker price. Financial aid typically comes in 4 forms. Grants are essentially gifts that do not need to be repaid. They're typically based on your family's financial situation, though not necessarily strictly on income alone. These can be federal or state grants. Work Study is a federal program that provides on-campus work. If you qualify, the college or school will help you to secure a work study position on your campus, and your pay will be determined by federal work study hourly rates. Some students may choose to forego this option if they have off-campus employment, especially if it pays more. But the benefit of work study is that the university works with you to find an employment, and because it's on campus, you likely won't have to deal with transportation issues. Scholarships are awarded to students generally based on grades or other factors, or some combination. For example, you may receive a scholarship at your college that was provided by an alumnus from your hometown. She may specify a $1,000 scholarship each year to a student who graduated from your home school and who maintains a specific GPA or studies a certain major. Your school may match you up with these opportunities or provide you with a way to seek them out and apply for them, but you can also apply for scholarships on your own. The financial aid office at your school may have information for you on places where you can seek additional scholarships. Finally, the fourth main type of financial aid is loans, and this is the only type that must be repaid after graduation. Let's learn more about the types of loans you may consider. Loans are generally split up into four categories. There are federal loans, which are offered and backed by the federal government through a variety of programs. There are private loans, which may be offered by banks or other agencies and institutions. There are state loans, which can be student loans offered by the recipient's home state. And finally, there may be institution loans, which are offered by the college being attended. In this lesson, we'll focus primarily on federal and private loans, as they're the most common. Federal loans are part of the William D. Ford Federal Direct Loan Program, and they come in four main categories. Direct subsidized loans are for undergraduate students with demonstrated financial need. Direct unsubsidized loans are for undergraduate, graduate, and professional students, and these are not based on need. So your family's income may be too high to qualify you for a need-based subsidized loan, but you may have had a financial setback and not have savings available. An unsubsidized direct loan may be an option for you. Direct Plus loans are for graduate and professional students or for parents of dependent undergraduate students. And these help pay for education and expenses not covered by other financial aid. These are not need-based, but this type of federal loan does require a credit check. Finally, there's a direct consolidation loan, which is a loan that allows you to combine multiple eligible federal loans into a single loan. At the end of your education, especially if you've taken out several different loans, it may be more convenient for you to combine them into one payment, and you work with one loan servicer who meets your needs and provides customer service to you while you repay the loan. You may occasionally hear about other discontinued loan programs as well, such as a Perkins loan or a HEAL loan. These four types of loans that we discussed are the available federal loans at this time. So federal and private loans are the two main types of loans, and you may be wondering what the key differences are. First, interest rates on federal loans are fixed. They're usually less than that of private loans, and generally much less than that of a credit card. No credit check or cosigner is needed for most federal loans, but for most private loans you would need a credit check. With federal loans, repayment begins when you graduate or leave college or fall below half-time student status. You usually have what's called a grace period of 6 months afterward before you start making your monthly payments. However, on a private loan, repayment generally begins as soon as you take out the loan. And finally, if you demonstrate financial need, the government may subsidize the interest on some loan types while you're in school and even during some periods after you graduate or leave school. So, federal loans are better, right? Not necessarily. If you do have a very good to excellent credit rating, you might get a lower rate on a private loan, as much as 1.5 percentage points lower. But it's worth considering every option, especially if you'll need to delay repayment until after graduation, or if your credit is not yet established and you would not qualify for a private loan. Regardless of what your financial aid package looks like from any given school, it's important not to take out any more loans than needed, and then you can pay back. In the next exercise, you'll be asked to consider some repayment scenarios, which will help prepare you for the remainder of this lesson, in which we'll explore responsible borrowing and repayment options.